If you open a franchise cafe expecting to get rich selling $4 cups of coffee, you have already walked straight into a multi-million-dollar financial trap. Right now, thousands of ambitious investors are handing over their life savings to global fast food and coffee giants, convinced they are buying a golden ticket to passive wealth. They see long queues of caffeine-addicted customers spilling out into the street every morning, do the quick math in their heads, and assume the money practically prints itself. But what these corporate sales pitch materials will never tell you is that the parent brand always gets rich first. The landlord takes a massive piece of your soul, and you are left risking everything just to fight for the leftover change sitting at the bottom of the cup. Before you ever pull a single shot of espresso, there is a brutal financial mechanic running in the background that can wipe out your entire bank account, and we will uncover the exact hidden clause that causes 60% of new owners to break down in tears by month 6. To understand how this money trap works, you have to realize one fundamental truth. Buying a franchise is not buying a business. You are renting an extremely strict prepackaged financial machine. The pitch from corporate headquarters sounds absurdly simple. They promise you that starting an independent coffee shop is a suicide mission where 8 out of 10 fail within 5 years. By signing their contract, you skip the terrifying guesswork. You get instant brand trust, a ready-made supply chain, and an operational system so simple that a teenager on their first day of work can execute it. But that convenience comes with a financial price tag that will make your eyes bleed before your front doors even open. Long before you welcome your first customer, you have to wire a massive, non-refundable initial franchise fee just to paint their iconic logo on your window. For a globally recognized coffee brand, this entry ticket alone costs anywhere from $40,000 to $60,000 cash. But that initial fee is merely the cover charge to step into the arena. Next comes the nightmare of the physical store build-out. Franchise corporations strictly forbid you from saving money. You cannot buy comfortable chairs from a discount store or put up custom art. Every single square inch of your store must be sourced from corporate-approved vendors who mark up their prices with impunity. Let us look at the actual eye-watering line items required to build a single location. That industrial espresso machine sitting behind the counter? That is not a standard $2,000 appliance. It is a custom-calibrated commercial-grade monster that costs upwards of $35,000. The specialized floor tiles required to match corporate brand guidelines nationwide will run you another $20,000. The heavy-duty commercial plumbing, industrial grease traps, and ventilation systems needed to satisfy both city inspectors and corporate auditors regularly hit $150,000. Add in digital menu displays, custom granite countertops, and drive-thru speaker hardware, and your total startup investment easily rockets past $850,000. Most first-time owners take out massive bank loans backed by their own personal residential homes to finance this construction, believing the daily revenue will effortlessly pay off the debt. When you sit in a busy terminal and watch 500 customers spend an average of $8 every morning, you see $4,000 a day in top-line revenue. That looks like nearly $1.5 million a year flowing through the register. But top-line revenue in the franchise world is the most dangerous, deceptive number in existence. The actual story of franchise economics is not about how much cash comes through the front door, but about the line of financial predators waiting inside your corporate bank account to take their bite before you ever touch a dollar. The very first predator standing in line with an open hand is the franchisor itself, and they take their cut off the absolute top of your gross revenue. This is where most first-time owners make their fatal mathematical mistake. The corporate mothership does not care if you had a record-breaking month or if a pipe burst in the basement and destroyed $50,000 worth of inventory. They collect a mandatory, non-negotiable ongoing royalty fee of 6 to 8% on every single dollar that passes through your register. On top of that, you are legally forced to pay another 3% into a national marketing fund. So, before you buy a single coffee bean, before you pay your electric bill, and before you pay your hardworking staff, roughly 10 cents out of every single dollar collected has already vanished directly into corporate headquarters. And as we will see next, this creates a terrifying conflict of interest where the parent company can make millions while you face complete personal bankruptcy. This financial setup creates a brutal misalignment of incentives. The parent company makes its fortune by maximizing total sales volume across hundreds of locations, completely ignoring whether an individual store is actually profitable. If your store generates $1 million in gross sales, Corporate collects their $100,000 in guaranteed fees. Whether you make a comfortable profit or go bankrupt paying operational expenses is entirely your personal problem. They enjoy low-risk, scaled royalties, while you shoulder every single drop of operational debt, lease liabilities, and daily financial stress. Once corporate takes its guaranteed top-slice cut, you enter the grueling battlefield of prime costs, raw inventory, and direct labor. In the coffee world, people often talk about legendary profit margins. A single espresso shot uses roughly 15 cents worth of roasted beans, and when you mix it with hot milk and sweet syrup, you sell it for $6. On paper, that looks like an incredible 90% gross margin. But modern consumers do not just buy basic black coffee anymore. They order complex handcrafted drinks with oat milk, double caramel drizzle, custom cold foam, and imported vanilla. Every custom modification chips away at those margins. Dairy and plant-based milks are highly perishable items subject to sudden price spikes. Furthermore, paper goods are a silent killer. Branded double-walled cups, custom lids, heat sleeves, and printed napkins devour another 6% of your total drink revenue. When you factor in milk spoilage, accidental spills, employee freebies, and routine waste, your actual cost of goods sold settles between 25 and 30%. That leaves you with 70% of your revenue, which immediately gets devoured by the most unpredictable expense in the entire industry: labor. Unlike a retail store where one clerk can manage a quiet shop, a high-volume franchise cafe requires absolute military precision. During the morning rush between 7 and 9 in the morning, which generates over 60% of your entire daily profit, you need a full army behind the counter working in total synchronization. You need dedicated baristas pulling espresso shots, support staff building cold drinks, cashiers processing payments, prep cooks warming sandwiches, and floor runners restocking cups and wiping tables. This is where the operation becomes a terrifying tightrope walk. If you try to save money by scheduling one less worker and the drive-thru line backs up into the street, morning commuters will not wait. If a customer waits more than 4 minutes for their morning fix, they will pull out of line and drive straight to your competitor down the road. You do not just lose $6, you lose that customer's lifetime value forever. On the flip side, if you schedule a full crew and an unexpected rainstorm hits at 2 in the afternoon, turning your store into a ghost town, your labor cost percentage skyrockets into the danger zone, instantly erasing all the profit you made during the morning rush. When you add up hourly wages, mandatory employer taxes, worker compensation insurance, and the constant cost of recruiting and training new staff in an industry with an 80% annual turnover rate, labor effortlessly devours another 32% of your gross revenue. Combine 30% for raw materials, 32% for labor, and 10% for corporate fees, and 72% of your incoming cash is completely gone before you even look at the utility bills required to keep the lights on. This brings us to the most dangerous silent partner in the entire equation: the commercial landlord. Franchise cafes cannot survive in cheap hidden locations. They require prime real estate with maximum visibility, heavy foot traffic, and a high-speed drive-thru lane. Drive-thru lanes are the ultimate cash generator in modern coffee franchising, accounting for up to 70% of total daily revenue. But property developers know this exact math, and they price those premium corner locations with extreme aggression. A prime suburban drive-thru spot can easily demand $10,000 to $15,000 a month in base rent alone. To make matters worse, most commercial leases include a predatory clause called percentage rent. This clause states that once your store reaches a certain sales milestone, the landlord is legally entitled to take an extra 3 to 5% of your gross sales on top of your heavy base rent. By the time you combine base rent, property taxes, common area maintenance fees, building insurance, and the massive electricity bills required to run industrial ice makers, refrigerators, and high-voltage ovens 16 hours a day, occupancy costs eat up another 14% of your money. Let us do the final brutal math on your $1 million franchise location. Out of every dollar taken in at the register, 30 cents goes to inventory and paper cups, 32 cents goes to staff wages and labor overhead, 10 cents goes directly to corporate royalties, and 14 cents goes to the landlord. That leaves you with a razor-thin spread of just 14 cents on the dollar. Out of those remaining 14 cents, you still have to cover credit card processing fees, software subscriptions, equipment repair contracts, trash removal, night cleaning crews, accounting fees, and the interest payments on that six-figure bank loan you took out to build the store in the first place. When the dust finally settles at the end of the year, the average net profit margin for a franchise cafe lands between 6 and 8%. On a store generating a massive $1 million in annual revenue, the owner is left with a net profit of $60,000 to $80,000. That is a modest salary for an investment that required nearly $1 million of upfront capital and personal collateral. And more importantly, that income is anything but passive. If a shift supervisor calls in sick at 5 in the morning, or if the main ice machine breaks down on a 90-degree Saturday in July, corporate headquarters will not send help. They will send an inspector to fine you for violating brand standards. You are not a relaxed business owner enjoying passive income. You are an overworked, high-stakes manager bound to a corporate contract. So why do smart investors continue to build franchise coffee empires? Because they understand the hidden secret of scale. Owning one single franchise cafe is a stressful, low-margin job. But owning 10, 15, or 20 locations fundamentally changes the financial rules. Multi-unit operators do not stand behind the counter or manage individual shift schedules. They build a corporate management system that shares administrative costs, commands bulk purchasing power, and spreads operational risk across multiple high-volume properties. If a single store produces $70,000 in net cash flow, a strategic portfolio of 10 locations generates $700,000 a year in clean profit. At that level, the owner can hire dedicated regional directors to handle daily operations, transforming the business into a true wealth-generating portfolio. Furthermore, when multi-unit owners decide to exit, private equity firms buy those multi-store networks at massive valuation multiples that single-store operators can only dream of. Success in the franchise world is not about brewing the tastiest cup of coffee or offering the friendliest smile. It is an unyielding game of operational discipline, brutal cost control, and strategic scaling. The corporate parent provides the famous logo, the national marketing, and the operating manual. But you must bring the capital, the physical stamina, and the relentless daily focus. If you jump into franchising expecting easy money, the reality of high rent, strict royalties, and thin margins will destroy your finances. But if you master the underlying numbers and scale your operation like a seasoned operator, that simple cup of paper-wrapped coffee can build a multi-million-dollar commercial enterprise.